All right. Good afternoon, everyone, and happy Thursday. Welcome to our quarter one client webinar. Hard to believe the first quarter is already over. It's been a fast start to the year. Obviously, a lot of people are happy that tax time is over. That's always great. In our industry, once we're past that day, because there's a lot of work that goes into that kind of stuff for our clients. And as all of you know, so what we are going to do today is do our, like I said, quarterly webinar that we do every quarter, where we're going to give you some updates on what has happened in the last quarter in the stock market, as well as in the economy as a whole. And then we'll also talk a little bit about what we're paying attention to going forward for not only the next quarter, but the remainder of this year as well. And with me today is Josh Stirling, our Director of Portfolio Management, and Eric Schwartz, an advisor in our office. My name, for those of you that don't know me, is Kite, and I am the CFO and an advisor here at Klaas. So thank you, everybody, for joining us today. Go ahead, Josh. All right, so like I said, we'll get us started here. These are some of our numbers that we update every quarter that you can see right on our website. So thanks to you wonderful folks. We have been in business for 48 years now. Actually, next month is when we were founded, May of 1976, so 48 years. So thank you all again for trusting us with your retirement assets and allowing us to help you plan for retirement. We have about 1,030 clients as far as households go. We have 20 employees in 2 locations. Of course, our headquarters is here in Loves Park, Illinois, but we also have our office up in Madison, Wisconsin. And we officially crossed over that 700 million threshold in assets under management by the end of the first quarter. So we're really excited to see that. Those big round numbers are always cool to see come into place. And we help clients in 32 different states. So again, as most of you know, Illinois, Wisconsin aren't always the places that people choose to stay when they retire. A lot of them chase warmer climates or follow the grandkids and that kind of stuff. So we're happy to help people all throughout the country.
I don't know what you're talking about, Kyle. It seemed like this winter was relatively easy, right? No major blizzards or anything?
Yeah, we can't complain about this winter, really. That's for sure.
That's true.
All right.
All right, let's
go ahead and start us off.
Yeah, let's get started with what I feel like we talk about every quarter right now, interest rates. So first big news topic here, we have seen, especially over the last few weeks here, some continued volatility in the markets, largely related to Fed policy, or maybe more what people expect the Fed to do or not do. I think not too long ago, we were hopeful that we may see somewhere between 3 and 4 rate cuts throughout 2024. I think largely those hopes are dashed at this point, as we've continued to see some higher inflation numbers. And now there's talk we may not see a rate cut until early part of 2025. So I think, especially as I said, over the last few weeks, we've seen that just start to ripple through the markets and see the market go the other way from what we've seen since October.
Yeah, I think it was just maybe 2 or 3 weeks ago that we first started hearing some of the economists come out and start saying, hey, there actually may not be a reason to do any cuts at all this year, which was kind of a surprise in the market. I think it settled the tone for the rest of the year that maybe there needs to be an acceptance that 3 rate cuts isn't a reality that we might see.
Yeah, and I mean, the Fed, as we've talked about this on the last few webinars, they've been really cautious as we've worked through kind of these inflationary issues. They've been really cautious, and we've seen the last 2 months now, we've seen some signs of very sticky inflation, and they're probably going to stick with rates as they are until they can get inflation down to that 2% goal that they have. So we'll see what comes here. I feel like every quarter I look back at the webinar and say, oh, maybe that came to be, or maybe it didn't. But as we sit right now, I think all of our clients have noticed we've seen a little bit of movement in the market recently.
Mm-hmm.
Another news topic, lot of happy news topics today. We are seeing continued layoffs, specifically in the tech sector. And I think we started talking about this last year, and in many ways, I think 2023 saw a lot more job cuts in the space than 2024 has. But really, the layoffs we've seen have really been almost sector specific. We have a couple of examples right here on the screen: Microsoft, Dell, PayPal, and Bumble. And I wanted to put a little bit of context around these, just to kind of help people better understand. These look like big numbers, and obviously they are. But like starting with Microsoft, for example, 1,900 employees, 1,900 reduction of 1,900 in their headcount. That accounts for less than 1% of their overall staff, and it's really focused in a space they recently acquired, Activision Blizzard. And looking at Dell, for example, cutting 6,000 employees. This is, about a 5% reduction. They've specifically cited just kind of a drop off in demand that they expect to turn around come 2025. So really, I think as we talk about this space in general, there's been a lot of excitement around artificial intelligence and what that could mean for the economy and the world. And I think it's also created a lot of space for organizations to reduce headcount and lay people off. Whether or not it's directly related to that, it is just sort of an opportunity for them to what they would call right size the employee count. But again, we are not seeing this as an economy-wide phenomenon. It's really been so far primarily focused in this space. But let's take a look at the labor market more broadly. So looking at things right now, unemployment remains historically low. And we're looking here at what we call the total labor turnover. So this is actually looking not just at how many jobs were filled last month or how many people lost their jobs. What we're specifically looking at here is taking everything into account. Okay, so we're looking at people who were laid off from their job, people who retired, people who quit and took a new job, and then we're looking at the impact on net hiring from kind of putting it all together. So what we're looking at here is basically how much of the workforce is in transit, you would say. And you can see right now we're at about 3.5%, so we are below long-term averages, and certainly a far cry from the 11% we saw back in the early stages of the COVID pandemic. But really, when we're looking at this, and we're looking at the number of people that are actually maintaining their job or staying in a specific role, we're hopefully looking towards some continued stability in the labor market as a whole.
Mm-hmm. And I look at that number and when I hear that the U.S. job force has a turnover of 3.5%, at first that sounds really high. But I guess when you put it into perspective of, well, there has to be some natural level of turnover as people change jobs all the time. There are occasional layoffs, but there can be so many factors that come into play that actually create that natural turnover. And sometimes, not always, because layoffs do come in chunks, and they can spike that number as we saw with COVID, but that also helps the efficiency of the job market, having people being able to transition from job to job to job as needed.
Or from our perspective as a retirement planning firm, people moving from the workforce into retirement.
The most important factor on there.
Yeah, so I'll look at inflation here. So Eric alluded to this a little bit earlier in his opening slide here. This is what we're looking at here. There are so many different measures of inflation, and we've used various ones over the last few quarters because it is still one of the kind of biggest headline topics that everyone's paying attention to. But you'll notice this is what they call sticky price inflation minus food, energy, and shelter. So why we chose to use this one this time is not very many people are probably familiar with this, but it does have a lot of the aspects of inflation that a lot of us see on a regular basis. But when they consider it sticky, that means prices don't necessarily move day to day or even week to week. They have a much longer turnover before prices change. So think of something that's not sticky would be like fuel prices or groceries or something like that that changes on a more frequent basis. What we're looking at here is more like recreational costs or going out to eat, right? Your favorite restaurant doesn't change its prices every single week. It may have felt like that in the recent history here because prices have gone up quite a bit. But this also includes things like your automobile insurance, your homeowner's insurance, stuff like that. Now, everything has different weightings, so it doesn't mean that everything is weighted equally. They look at various factors and how much those weights occur. So this is actually a pretty long time frame here. You're looking at close to basically 4 years of a rolling average here. So you can see that we peaked on this category back in early 2022. It was on a decline up until last fall, basically, and we've had a little bit of an acceleration over the last 6 months here or so. So while this is important, is we're trying to give credence to why we say that the Fed may be a little more cautious on rate hikes and things like that, or rate decreases and things like that, because when you have data like this, they're very scared about cutting rates too soon and re-accelerating in inflation in different parts of the economy. So if anything, they're going to be overly cautious to avoid that happening. But when they get a data point such as this, where a piece of inflation is sticky, they're going to, again, be more cautious of it. We chose to pull shelter out of this because we've talked about that a lot over the last 6 months, and that's one that is staying stubbornly high. Housing prices have not come down significantly. Although I did see something now that mortgage rates have gone back over 7%, the housing market is starting to freeze back up a little bit. So there's something about that 7% number, probably more psychologically than anything, that people just don't want to get locked into when it comes to housing. But again, these are just there's so many different factors that go into inflation. The Fed looks at so many different things when they, it's not just headline CPI or anything like that. There's a various number of factors that go into this when they're making their decisions.
Yep. And to the point that you made about housing remaining stubbornly high, it still continued to come down. This is a chart that we check regularly on where shelter is and how housing's coming down. Again, we've talked about it maybe a bit too much, but it is still trending down, even though it's staying stubbornly high.
We'll talk about it even if it's not on the slides.
Yeah.
All right. And this one is another beautiful chart that we've pulled through. If you guys remember, if you joined us for our first quarter one, we did a different chart on just how the stock market performs during election years. But this is a look back all the way to 1937 of what the S&P 500 has averaged throughout those years, and it's shaded by which party held the presidency during this time. So this is why we say the market is pretty much agnostic to politics when we look at these kind of things, because we can find so many different charts and things of that nature that prove that as long as they're not proposing anything that will, hurt company profits or, raise taxes insanely high, those kind of things, the market usually does fairly well no matter who's in the presidency. So, and when you look at this, it's kind of interesting to see just how often it flips between blue and red and how it's fairly even throughout the last 90 something years that this is showing. So,
and we go back and look at that amount of time. It's always it's nice to see a good solid 12% average annual
up and to the right. Yes.
All right. Well, thanks, Kyle. We're gonna kind of turn the page here and we're gonna talk a little bit about returns. And as people who have joined the last quarterly webinar know, 2023 was a very strong year. However, we did have a blip back in the end or back in the middle of Q4 2023. So what we're looking at right here is we're looking at the past 2 full quarters. And you can see that little blip where all the returns for bonds, stocks, and our balanced portfolio or 60-40 portfolio kind of hit the bottom right around that end of October, early November time frame. But since then, we saw a ramp back up in the market, both from bonds and stocks. And that really helps cement the really strong year in 2023. The story so far in 2024 is that the market remains really strong, especially from a stock market perspective. Now, I know the past couple of weeks, as we've kind of hinted to a couple of times, have been not as nice, but we're still at a really high spot compared to the beginning of the year. As a matter of fact, towards the end of the first quarter of this year, you started seeing that a lot of indexes in the stock market started hitting all-time highs again. And it's really refreshing to see us get back to those high spots in the market. The S&P 500 hit maybe about a half a dozen days where it hit all-time highs again and again and again, speaking to just the strength in the stock market. Looking at the past 6 months, in our most commonly used portfolio, the 60-40 portfolio, being up almost 10% over those 6 months is a really strong return to look back on. So we're in a really good spot there.
One thing I want to just point out here, and I think this is really important. I think we beat this drum every quarter, and I probably is me a lot of the time. But if we look at, I mean, 2023 was ended up being a really good year in the market. But if you were not in the market for the last 2 months of the year, you actually had a negative return, right? So while, many of the indexes ended up double digits for the year, they were down. You can see right here on the screen between 5 and 10%, all the way through the end of October. So we talk about this all the time, but it's just this idea that trying to time the market and try and be smarter than it is just really, really difficult. And I mean, I think for someone who's looking at the market in October of 23, they're not eager to jump back into the market, and they would have missed out on the last 2 months and obviously the continued growth since then. So it just really comes back to the way that we view investing and just what we kind of preach from a behavioral perspective.
Absolutely. And I think we're gonna in a couple of minutes, we're gonna revisit that conversation and
yes, we are.
I'm high here on a fun new graph that we built out, if you can call graphs fun.
It's a fun graph.
Final thing I'll point out on this screen is the bond market. And we're going to take a few minutes and we're going to chat about the bond market here because it's up from where it used to be about 6 months ago. The bond market's continuing to kind of move in a positive direction. But since the beginning of this year, it's been horizontal. It's been a little flat. And that's really been as we've seen kind of interest rate hikes, interest rate cuts, that kind of perspective on what might happen throughout the year come to reality a little bit and seeing that back off slightly. So we're going to move to the next slide here, and we're going to kind of stretch out that perspective. So last slide, we were looking at the past 6 months, really short term. Now we're going to kind of stretch that out to 2021. And looking back to November of 2021, where the bond market was paying relatively low yields, still okay, but pretty historically low. Back in November 2021, your average bond market returns were giving you about 1.4% in coupons, yields. So relatively low. And then as we kind of move forward, you saw the bond market kind of go through that experience of the interest rate hiking environment throughout 2022, and the bond market kind of repricing over that time frame. And that was a hard time that we all kind of talked through, we worked through, and we always said kind of take time, the bond market will return. Now, however, it's been quite a bit of time since that. And as you can see, over the past 2 years, it's had a little bit of volatility along the way. As you can see, it's been up and down in the total return. But it's mainly been going kind of sideways, a little flat with volatility. Now, there are a lot of aspects that can kind of come into play here on that. And we'll kind of talk through 3 of them here briefly. We'll touch on some big topics. We're not going to dive into them pretty deeply here, but we'll touch on them. In a typical bond market, you are typically rewarded if you buy a bond that's maybe 10, 20, 30 years out. You typically get a higher yield, a higher coupon, or having a bond further out. And then typically if you invest in something that's like a money market maybe a 3-month CD or 1-year T-bill, something like that, you typically earn a little less on that. In today's market, it's completely inverted. It's what's called an inverted yield curve. It's not normalized. It's happens occasionally, but it typically reverts over a short-ish medium-term time frame. But currently, we're seeing it extend out quite a bit. As many of you know, you can get a money market position. You could get short-term CDs that are paying maybe around 5%, maybe even a little higher. Right now, as you can see on the right-hand side here, April 2024, your average bond return is yielding you 4.2%. That's a lot lower than it is on the short-term perspective. So why is that the case? A lot of times when markets are looking at in the future where interest rates may end up being, they're predicting that the Fed's going to come in and start driving down interest rates in the future. So when you look at 10, 20-year bonds that are available, they're not going to offer those 5-6% yields that you might typically think they'd be offering, because in the future, rates are probably not going to be that high. Now, this is one of the key things that has caused the reality of that horizontal return over time, is that the bond market is slowly coming to the reality that interest rates are probably going to remain higher for longer. These longer dated bonds are kind of continuously getting repriced on the yield. And we're in a really strong spot currently with where yields are at. But that's why you're seeing the total return in bond markets kind of be below that break-even point. Now, this is something that we're watching pretty closely, and we want to have kind of recognition of when the bond market comes back to that break-even point of where we were back in 2021, prior to the interest rate hiking environments. However, the final aspect that comes into play when we're looking at this chart with where bonds are at currently, time is incredibly important in the bond market. Equity markets can typically revert pretty quickly. Back in COVID, everybody talks about the V recovery, where the stock market went down aggressively and it came right back up. Bonds typically don't take that path because they have fixed payments, they have fixed predictable coupons that come out. And so that's where we are today. This is something we've talked about for the past year and a half on kind of the current bond market, where it's going. And we've talked about the time that it takes to get the bonds returns back to kind of that break-even point. With all of that being said, where we are today compared to back in 2021 is a wildly different world. And it's actually a very strong position with a powerful 4.2% yield currently on an average bond portfolio. That puts people in positions of getting higher income off their bond positions. If interest rates go down in the future, we might get a little bump in return off the bond market. Being at this higher rate environment does put the bond market in a stronger position today, even though total returns are down from where they were about 3 years ago.
Yeah, and I think, I mean, we talked a lot about this back when this was happening, but we see this really drastic drop in value of bonds. I mean, that's not something we're used to seeing or really is generally expected from this space, right? It was this unprecedented hike in interest rates to try and slow down inflation that really caused the values to drop so significantly. And now as they come back, they're coming back in a much more normalized fashion for bonds. But we're starting from a much sort of out of ordinary space with that initial drop.
Yeah. And as we've already touched on a couple of times, the total returns in the bond market are impacted by what the Fed decides to do and how interest rates are eventually going to hopefully come down, and hopefully come down sooner rather than later. We'll see. But I would say temper expectations on that, and we'll see how returns in the bond market happen in the future. But if things normalize and things kind of level out, we'll hopefully hit that break-even point in the next 1, maybe 3 years in kind of a more horizontal perspective. But bond yields will help us come back over time.
Yeah, and you can see, I mean, I keep belaboring this, but at that December 2023 timeline and the months preceding that, you can see that jump in value and this hope that, or expectation that the Fed would be lowering rates come 2024 because we were getting good readings on inflation. And so the expectation was then that rates would go down. And so you can see how quickly the price can be impacted. But like you said, we have that more recent time period where we're sort of coming back to reality to some extent.
Absolutely. All right, let's move on to the fun chart. So we love doing research projects here on returns over very long periods of time, and also kind of challenging some of the typical thinking that you just kind of get pulled into on, well, what if it's a bad market right now? Should I get in or out of the market? Should I be changing my strategy right now because I think we're at good all-time highs, and let me back off that. To kind of dig into exactly what we're looking at here, this chart has 3 different shaded areas. The returns that we're looking at on the screen are just simply total returns from 1988 in the S&P 500. And what we do is we take little pictures along the way of what type of a return environment were we in during that time period. And so we have 3 different shadings. We have bear market, correction market, and expansion market. Bear market, for instance, is when the market is down more than 20% from the last all-time high. So if the S&P 500 was sitting up here at $1,000 and then it dropped all the way down to about 800 in very simplistic terms, we'd be then in a bear market territory. We color that with a gray coloration on the graph. Then a correction market is anywhere between 10% to 20% down from the most recent high. And what we do is we shade that with a lighter green color, a little bit grayish there. And we chart that all the way along. Everything else is in an expansion market where markets are generally positive returns. And you see a lot of all-time highs happening along the way. And we built this out because we want to show kind of the representation of how positive the market is over long periods of time. And when you look at different time periods along the path, there's always going to be times and moments where you hear people say, oh, maybe it's time to take risk off the table because we hit that all-time high recently. Well, for the most part, all-time highs are followed by more all-time highs. So it's important, kind of from our perspective, to stay invested in the market and to try to not time when you enter into the market. If you're sitting on cash for whatever reason, you bring something in, and instead, I'll let Eric talk about this a little bit, focus a little bit more on the financial plan and personal perspectives rather than what's happening in the market.
Yeah, I mean, we've talked about this a bunch of times, but this is that idea of time in the market versus timing the market, right? The more time you spend in the market, the more opportunity you have to be in one of these expansionary markets, right? And I mean, we're kind of talking about longer periods of time, but if we look at, you even shorten it, you look at some of these, call it 3 to 5 year time periods, you are in many cases better off to be invested rather than trying to jump in and out of the market and picking the right time. And I think what the other thing we're looking at here is, because we hear this a lot from people, well, I'm in retirement, I don't have a long time to wait for the market to come back. And I think that's where, from Josh's perspective, talking about, well, how does your financial plan work along with this? Well, the first part of it, and I think probably the most important, is most of our clients are not fully invested in the stock market. So we're looking at stock market returns right here. We are not looking at portfolio returns. Mm-hmm. We talk about the 60-40 portfolio a lot, our balanced portfolio, because a lot of our clients are in that portfolio, specifically the ones who are retired. So, I mean, this is one piece. This is your growth engine of your portfolio, the stock portion. But we have a portion of your portfolio that is invested in different asset classes that are not necessarily moving with the stock market, right? We talked a lot about yields and interest being paid off of bonds. Well, our retirees, there's a good chunk of your monthly distributions right now that are being covered by your interest payments from bonds. So it's really not a matter of should I be in stocks at all? It's more a matter of how much should I have in stocks, and that's a function of a lot of things. The amount you need out of your portfolio, the purpose of the funds, are you spending them down? Are you planning to leave them to kids or whatever it might be? But to us, it's really never a question of should I be in the market or out of the market right now. It's really a question of what do you need out of your portfolio, and we'll build a portfolio that can meet those needs.
Yeah, customization is better than rules of thumb, and trying to be as predictive as possible.
Right, and remember, we're not selling this all in one day, right? It's not like you hit retirement and it's like, well, whatever my balance is, this is what I get to live off of. We are, in many cases, sending monthly distributions to people. So you are breaking off small pieces over time, which really spreads out and reduces the risk that you sell on a down day, for example.
Mm-hmm. Absolutely.
I see a lot of dark green on that chart, Josh.
Yeah,
That's a good thing.
Yeah, I forgot to mention, the expansion market is over 70% of the time. Now we have to take a pretty short time frame here. I say short, it's still over 30 years, 35 years. We typically like to go back to the 1920s, 1930s, but this is all that we were able to kind of pull together. So 70% over the last 35 years. That's a very strong amount of time, or long amount of time, for a strong stock return.
And I love this part because even though it's only 30 years, Josh, it does have one of the worst decades for the stock market in history, which was that 2000 to 2010 timeframe. And so many people remember 2008 because that was, the worst correction in most of our lifetimes, right? But you see there, if you would have sold out in 2009 and you didn't get back in until 2020, let's say, how much return you just miss out on. So this is why we, again, beating the point home, but it's just time in the market versus when you get in and when you get out and those types of things, because like we said, 70% of the time it's going up. So.
All right. Well, why don't we move on to Q&A?
Sounds good.
We've got a couple of questions that just came in here, so bear with me here. These are some good questions that popped in. So let's take a look at this one right here, because I love it.
Great
Any
question.
indication that the Fed may actually raise interest rates this year? And I think I've heard a little bit of hubbub about this over the past couple of weeks.
Yeah.
But one of the Feds came out today, and this kind of interrupted the 10-year yield. Kind of had a little heartbeat that happened because I believe it was Fed Williams. He came out and made a comment saying that the blurb was that interest rate raises are not off the table. But I think that was a little stretched based off his comments. It really got driven from if data supports it, then yes. It was more of a factual, if we need to, then yes, we will, rather than I predict we will. So I think some of those headlines that you might have seen are kind of reading into things a bit. But we'll see. I think it's more of a wait and see.
It is. I think what was said today was really no different from what we've heard from Chair Powell and from the other members of the Fed. And it's just, we're going to follow the data. We're going to do what needs to be done. I think some of them are enjoying being talking heads a little bit and commentating on what's going on in the market, and everybody's very interested in what they have to say. But truth is, we don't know. I think there's also been a lot of discussion of sort of what raising rates would do beyond what it's already done, right? Mm-hmm. So there's raising rates can be really good at slowing down the economy and really getting people to stop spending as much money, not only people, but businesses. And so there's this discussion of, okay, well, does another 1/4 point or 0.5% in interest rates, is that really going to solve the fact that housing is really expensive, or that, home and auto insurance is getting really expensive, right? So we'll see. I tend to lean against no, but lean towards no, I mean.
Yeah. Yeah.
That's not a prediction though, of course.
All right. Eric and Kyle, this one might be a good one for you. So as people age, how does someone know when it's time to change their investment strategy?
Such a
Kyle,
great
you want to take that one?
question. Yeah, it's such a great question. It's one that we get all the time. And honestly, there's no like perfect answer to it because so much of retirement planning and investing is based on your personal situation. It's how long are we going to leave this money invested? Because just because you're 85 years old doesn't mean that you shouldn't have anything in the stock market, right? And in fact, you could argue that if you've got enough money to comfortably last the rest of your lifetime, then this money is invested for kids and grandkids. So you should actually move it to more aggressive in some situation like that, right? So there's no rule of thumb, when it all comes down to it. I would say that as you get close to retirement, meaning within 5 or 10 years, that's probably when you want to take some stock off of the table. Because if you have a 2008 or even a 2022 come in the year that you're going to retire and you're overly aggressive, 2008, for instance, the market dropped 50%. So if you had $1 million in your portfolio, it got cut in half because you were too aggressive being all stock at the end, or too close to retirement. That's not what you want to have happen, and something that it's really catastrophic. And that if you get cut in half the year you're going to retire and you're going to start pulling out money the next year, you're going to be hard pressed to make that kind of money back up over even a 30-year time frame. It just gets so hard. But like I said, at the end of the day, we have plenty of clients that just because they're in retirement, we don't have to move their strategy much because, again, you don't have to be overly aggressive to get a consistent 5, 6, 7% return, which is why we focus so much on controlling what we control with withdrawal rates, with things like that. So if you're pulling a sustainable withdrawal rate, you can, afford to keep a little bit in stock. And again, with bonds up now at 4 and 5%, honestly, it just looks that much better for a balanced portfolio because you have a good floor of more consistent income with the interest that bonds are paying and things like that.
And I think it's to one of your points, especially if somebody's coming up to retirement and they actually need their portfolio to supplement their income, that becomes very important to really look at that closely. But we also have other clients that are more so in the picture of, hey, I've got Social Security and I have a pension, and my pension actually supplements all my income. That kind of a scenario is far different from what we see for somebody who relies on their portfolio and probably might need to have a different portfolio construction design for them.
Yeah, I think generally, just last comment on this, I find clients are often surprised that, as Kyle said, as we close in on retirement, call it that 5 to 10 years, we are generally adjusting the portfolio at that point. And then this isn't always a rule of thumb, but in many cases, we get to retirement and that's where the portfolio remains. It's not like this continued decrease in stock exposure just because they're aging. It's more, okay, this is the portfolio that supports the income that you need. So we don't necessarily need to get more conservative because the portfolio is able to support the withdrawals they're taking and also remain invested to grow for their beneficiaries if that's the case. But I think people are often surprised that we don't continue to recommend that they decrease their stock exposure just because they're aging.
Yeah. All right. Great question.
I like this question that's very
Yeah.
simple.
Mm-hmm.
So let's do that one.
Okay. This one right here. Why does the market care so much about the Fed? And I feel like this is a fantastic, very broad question, simple yet broad. I would actually love to see how many client webinars that we have where we haven't talked about the Fed.
Well, that's why I wanted to cover this because this seems like something that we should definitely make sure clients understand because we use it as a point of discussion a lot.
Yeah. Well, I think to kind of kick it off, the Fed essentially has one of their major tools that they can use to try to impact what's happening in the economy in America, and that's changing interest rates. And changing interest rates has this overarching reach of just the impact that it can have across the board. Raising interest rates makes borrowing for businesses, individuals, families, much more expensive and can really impact the level of spending, the level of investment that all these different participants kind of have access to or want or desire to get done. This impacts everybody's kind of personal cash flow level, company decisions on new projects that they're going to do. So people really concentrate on the Fed because the decisions that they make have consequences and heavily impact what happens in the market, even though it takes a long time to see that impact play out. It's really important.
I also think, I mean, the stock market is generally it trades based on expectations of future earnings of corporations. Lower interest rates generally means lower cost to borrow, not generally, it means lower cost to borrow, and it allows businesses to expand and grow, and also individuals and consumers, which in general will grow the economy as well, so when rates drop, there's a lot more hope of higher profits in the future, which will then push the market higher.
Absolutely.
And I think it's important to note too that, this, the Fed committee meetings have just become a thing in the last 15, 20 years. Like prior to 2008 and 2009, this wasn't like a big thing. The Fed would literally meet behind closed doors and interest rates would change, and that would freak the market out, right? So the market, to Eric's point, is trying to predict what's going to happen in the future. It doesn't like surprises. So when you just surprise them by raising interest rates all of a sudden, it wouldn't like that. So any information that the market can glean from what's going to happen with interest rates, that's why they pay so much attention to it as well.
All right. I think we've got time for one more question here. And I think it's a good one that we could talk for a while on. So while I don't understand that you don't time the market, how do you assess current PE ratios relative to long-term financial plans? I'll kind of lay it out here real quickly on its price to earnings ratios, which is a measurement to look at kind of the price of a stock relative to the earnings that a company is putting out. And it's generally a quick rule of thumb to see if a stock is overvalued or undervalued. If PE ratios get too high, it means the value of a stock is getting really high compared to the earnings that they're earning. If the price on a stock goes way up by 20%, by 50% over a year, but earnings are just trickling up little by little, you're going to start getting PE ratios that we see today, which is like 20x earnings or 30x earnings. It changes based on sector, based on company. There are a lot of things that impact it. But a big conversation piece today is that PE ratios are getting unusually high. And it has a lot of people worried about, could there be a reversion in the market? Why are these PE ratios getting so high relative to what the earnings are actually happening? And so PE ratios over the past 10 to 20 years have gotten a lot higher. And a lot of that has actually kind of come from the really good interest rate environment that we've had. It's been a really good competitive place for businesses to succeed and invest. And they've been able to allow themselves to kind of grow and have very good longer term perspectives. And as we talk about, the markets trade on future expectations of future returns. And so that's kind of what you're seeing of why those have started to go up more and more is the expectation of future earnings. We've been in a really great growth environment for a long time. But Eric and Kyle, I'd love to hear from you kind of more so on the planning side. How does this impact you more from a planning perspective?
I think that as we look at something like the PE ratios is not going to generally be something that we're thinking about specific to, withdrawals. We're more looking at long-term performance of the portfolio. And we're generally building in some level of cushion, right? So when we build a financial plan, we're not shooting for the moon in terms of return expectations, because we want to make sure that you're in a secure place outside of that, so that when inevitably the market moves, whether that's quickly or doesn't give us the long-term returns we expect, we want to make sure there's some wiggle room in there, so you're still in a good spot. I think from the perspective of the portfolio management side of this, I think while PE ratios do play they do play a role to some extent.
They do.
In portfolio construction, we're just not generally going to be trying to guess what that exactly means for the portfolio.
Yeah, and I'll say one of the biggest pieces that I talk about with PE ratios, because we hear this a lot, and it's a valid concern that PE ratios are high. I'm a little concerned investing into the stock market. PE ratios have been high comparatively for a long time, and it's one of those things of a lot of news articles coming out, a lot of hubbub about these are all-time highs. I mean, it's the exact same thing that we just looked at on the chart of kind of where things are at now, all-time highs. How could the stock market possibly go higher? And if you took that with validity and said, PE ratios are too high, obviously there's going to be a retraction. The stock market's going to come down. It's going to normalize. By stepping out of the market for any kind of substantial amount of time, you're losing out compared to where the market ends up in the future. If we would have listened to those news pieces, those news stories, and the different aspects that come out, trying to analyze why the PE ratio is too high, you're going to be back behind where the market is in the future, and it's going to be even more difficult to get into the market in the future, as well as you've looked out on those missed returns and markets are hitting more all-time highs in the future.
I think we've seen PE ratios not necessarily be an indicator of whether the market is heading up or down, and be more a function of a changing economy, right? Tech companies tend to trade at much higher PE ratios than say a manufacturing company, for example. So I think we want to be careful not to take direction from something that may not necessarily be an indicator that the market is heading one way or the other.
I think it can be helpful for looking and saying, well, market's at a really all-time high today. Maybe if you're changing strategies or something, maybe it gives a little something extra. But for the most part, we look at it as being a long-term investment opportunity and really driving the ultimate decisions of what you should do in perspective with the market, really in tandem with your financial plan. All right, perfect. Well, that actually is all the questions that we had pop in today. So thank you very much, everybody, for joining today. Thank you for entrusting the Klaas team with helping you retire, helping you plan for your retirement and success through all that. Thanks for joining, and we'll see you again in 3 months. Bye.
Bye, everybody.